Many moons ago, I had an opportunity to actually address an August gathering like this, where the topic for discussion was mutual funds to go mainstream in the next decade. Clearly, mutual funds were the alternate products in an era of high fixed guaranteed returns. Today, as I speak, mutual funds have become mainstream and are now a rite of passage for any new investor, any new committed investor. In the last few years, as the wealth and the wealthy have grown in this country, there is a growing appetite for nuanced products like AIFs and PMS schemes. Interestingly, they are now clubbed as alternates. And coincidentally, I stand here today in front of you making a case why these investment avenues are increasingly moving from being a choice to a need over the next few years. I have a lot of data to present to you, and I had great fun in making this presentation. I hope you enjoyed it as much as I did. So just to start off, this is the broad agenda which I'll be running through. Now let's talk about financialization of savings and the evolution of wealth in this country. I mean, a lot has been spoken. You will have a lot of data points, but I'm just going to focus on a few select data points. The unprecedented wealth creation in this country over the last 5 years has been stupendous. More so, keeping in context the fact that globally, wealth engines, wealth economies have stalled. India ranks ahead of most global markets. Today if you talk about where to invest, it could be either US, China, or India. Now let us just understand what is this manifesting into. You have over 150 unicorns which are likely to come in by 2025. Over 200 family offices in the country today. And more interestingly, this is a data point which really fascinated me. Over 30% of the estimated $100 billion which are required for the growth of startups are likely to be funded by family offices in this country. Interestingly, ultra HNIs are likely to grow by over 40% in the next 5 years, and HNIs, which is a broader swath of people, is expected to grow by 75% in the next 5 years. This is the growth of the wealth and the wealthy in front of you. Now, if you look at the transition of wealth in this country, this is a very interesting slide which talks about how wealth is being transitioned from the bottom of the pyramid to the top of the pyramid, and how it is going to manifest in terms of not just consumption patterns, but saving and investment patterns. Clearly, you're seeing that the inflection point of $2,000 per capita in terms of GDP per capita is transforming the way the Indian investor, the Indian consumer is starting to look at a variety of things. With more households now starting to moving from mid to affluent to high net worth buckets, you're going to see not just consumption, but spending, saving, and investment patterns change. We are already witnessing this in terms of launch of more sophisticated products like structured debt, private credit, and venture debt. This is an interesting slide again, and I'll just highlight one data point. We are talking about number of millionaires. India is among the top countries in terms of number of millionaires. Already you are seeing us rank right up there and moving very rapidly. But interesting point here is, in 2007, when China crossed the $2,000 per capita benchmark, at that point of time, there were only 415,000 millionaires in China as compared to 7.65 lakh millionaires in this country today. As the economy grows, as the Indian investor becomes more and more aware of what are global trends, there are going to be changing investor preferences, need for nuanced products. There are some interesting surveys which have been done, and I will just go ahead and talk about that. But more importantly, let's look at what are the select alternative products which are expected to lead. I think there has been a discussion about active versus passive, and if I have to just stretch that argument a little further, actively managed products as a category have been hard-pressed to beat passive managed products over the last few years, which is why you've seen a growth in the passively managed funds industry worldwide. However, sophisticated investors are now starting to look out for alternate products, more nuanced products, to achieve returns which are better than public markets. Investors are wanting to invest part of their portfolios in options which offer large illiquidity premiums. There's a very large illiquidity premium available for longer lock-ins and complex deals. And that is the reason why private equity, hedge funds, and real estate products in particular have started to grow. As the graph suggests, private debt, real estate and private equity are expected to grow faster than traditional investment. This is a slide I think which has just been displayed. I'll highlight this in a very different way. The global alternatives industry has been evolving over the last few years, especially over the last decade. In this country, in India, AIF industry is still at a very nascent stage. While the overall AUM is expected to grow at an average rate of around 6%, you will find that alternates is actually growing at almost double the rate of traditional investment avenues, or expected to grow over the next 5 years. Interestingly, what I'm looking at when I talk to industry associations, the regulator, and my colleagues in the industry, it is widely expected that the Indian AIF industry will build its own ecosystem on the strong backbone of what is actually happening in the public markets. Remember, alpha is still available in the public markets. So the Indian AIF industry is developing a strong ecosystem of its own. I talked to you about shifting preferences towards nuanced products in India, and this is actually manifesting itself in terms of where the investor is putting his money. The demand, the investor is becoming more and more mature. The demand, the mindset of investors is moving towards more premium and mature products, so demand is moving towards alternates. The bars in green are showing a clear investor preference of HNIs in particular towards alternates and nuanced products, whereas the demand for traditional products is actually coming down. This is one of my favorite slides. There was a survey recently done. Ultimately, at the end of the day, what does the customer want? The customer wants a few things, and if that customer demand can be met by a certain platform, by a certain asset class, demand will grow. So what is that the high net worth individual and ultra high net worth individual wants today in India? 5 major points. One is he's looking at creating new sources of alpha. He's exploring. He's more aware of what's happening globally, so he's looking at creating new sources of alpha. 3 out of 4 people have voted for that. He's looking at diversification. Now, diversification is not the conventional diversification you and I think, but this is for solutions across platforms. He's agnostic to platforms. He wants to capitalize on emerging opportunities. He's seeing a lot of money going into private equity, private debt, a lot of nuanced products globally, and he wants to capitalize on that. Close to half of them, they want to invest in these products, and because they're informed and savvy investors. They also want to reduce portfolio risk. It's not just return that they're chasing after. They're also looking at reducing portfolio risk. Interestingly, managing portfolio does not rank very highly in the overall scheme of things. I think these are smart, savvy investors backed by a bunch of smart, savvy advisors who believe that they can manage volatility and portfolio risk. HNIs and family office structures have 2 clear things. They want to preserve the wealth. They believe that that is the primary mandate, as well as grow their wealth. One of the things you'll notice here, the word savings does not come in at all. It is all about wealth and creation of more wealth. Moving on, if you talk about, I just talked to you about the what the investor wants, and I'll come back to that slide again and again. How are alternate investment funds addressing ultra HNI needs? There are 3 clear points which are being addressed. One is creating new sources of alpha, diversification, and capitalizing on emerging opportunities. Let me explain how. Arguably, this is probably the most versatile platform. An AIF platform is probably the most versatile platform which gives an ultra HNI investor access to innovation. It is not just innovation in terms of platforms, but it is also innovation across asset classes and capitalizing on emerging opportunities. There is a non-standard treatment. What that means is that you have a bunch of investors, a limited number of investors with a clear goal who are very focused on what they want, and they're very aware of what they're getting into. Access to the best minds, a plethora of young minds, good minds are starting to move towards the alternates industry, which is what these high net worth individuals, ultra high net worth individuals are looking to capitalize on. And more importantly, they want to capitalize on emerging trends. They want to have curated products. They can manage risk, they can manage volatility, I dare say they can manage tax. But what they want is basically curated products just for their liking. If one has to juxtapose by what's happening there globally, there's a broader trend of an increased allocation to private equity and startups, and being overweight on this sector because of the non-linear return profile of this asset class. Private technology companies are staying private for quite some time, and there's been a lot of money which has been made in private equity. As a result of which, there is a growing band of investors which wants to partake of that opportunity. For ultra HNIs and family offices who typically have a very long-term horizon for investments, This part of the market provides an opportunity for three things: better investment control, attractive risk-adjusted returns, and lower price volatility. As a result of which, you will find that not only has the alternate industry been growing over the last 5 years, but is projected to actually grow much faster. Interestingly, you will find a segment there which is private debt, and I'll talk about that a little more. This is one of the more exciting spaces to come to the Indian markets in recent times. Proof of the pudding is in the eating. How are investors partaking of this opportunity? And this is a small slide. On the left-hand side, it's a recent survey of some investors in terms of their allocation to AIFs. You will find that investor allocation to AIFs over the next 5 years, people have talked about getting at least 5 to 10% of their portfolio in AIFs. Interestingly, 1 out of 3 will actually increase their allocation to more than 25% to AIFs in the next 3 years. On the right-hand side, you are seeing an equal manifestation happening in terms of asset management companies, alternate investment fund providers, with a lot of them looking to raise money over the next 2 years. There are some very ambitious fundraising plans by the industry as well. How is this showing up in terms of the growth trends in the Indian AIF industry? Again, this is a very busy slide. I'll just highlight some of the points here. This is basically the number of funds launched across Cat 1, Cat 2, and Cat 3. And Cat 2, remember, includes a myriad base of investment, including private debt, unlisted equity. Increasingly, private debt is becoming a larger proportion of Cat 2 AIFs launched, but more about that later. Growth in the number of AIFs has been the highest in Cat 3 over the last 7 years, close to 32% CAGR. What does it mean in terms of commitments raised across the AIF industry? Again, commitments in Cat 3 AIFs have witnessed a 35x growth over the last 7 years, 5x just in the last 5 years. But Cat 2 has been one of the fastest growing categories with a CAGR of over 70% in the last 7 years. And like I said, private debt is increasingly forming part of it. I talked about private debt. Let me just explain to you the context in which it makes fund managers very bullish about this segment. Emergence of credit space in AIFs. In recent times, traditional lenders are becoming more and more averse to lending, have been more and more averse to lending, and traditional NBFC players, for whatever reason, they also have been at odds and evens in terms of their lending strategies. There's been a lot of asset liability mismatch at their end. This opens up a very large market for private credit players to capture. As India, gallops to becoming a $5 trillion economy, the demand for private credit will go up. The government has also introduced several measures to safeguard the interests of private credit lenders, or for that matter, lenders. We are talking about the creditor-friendly insolvency and bankruptcy code, dedicated tribunals to resolve corporate, commercial, and insolvency cases. This has laid a very strong foundation for something like private credit to come in. As you are seeing, credit as a segment has not gone away. It has merely shifted to a more savvy investor base. And the savvy investor base lies in the alternate investment fund space. Private credit is at an inflection point in this country. It is believed that if India is to become a $5 trillion economy over the next few years, it needs to add close to $2.5 trillion in credit to support this growth. And with banks turning cautious and NBFCs still finding their feet, this is a great opportunity for private credit AIFs. In fact, opportunities of more than $50 billion are expected to come in the next 5 years in the Indian context, in the private credit spectrum. Again, how does this pan out in terms of the investor, that is people like you and me who are putting money in private credit, as well as the manufacturer, the people who actually run the AIF. Now, 60% of investors believe that competition in private credit deals has actually increased in the last 12 months. It's a very interesting observation which I had, that not only do investors want to invest in AIFs dealing in private credit, but they would like to co-invest as well by putting in their own money. So there's been a lot of competition which has come into private credit AIFs. Consequently, there has been more depth in the market, more options for investors. There are better structures, more risk management, and it is a win-win situation for all. If you look at how manufacturers or people who lend money are looking at this segment, while there is a fair bit of conservatism over the next 1 to 2 years, over the next 3 to 5 years, I think almost every fund manager is very, very bullish on this segment. Globally, private credit accounts for 15% of private capital assets under management. That's a huge sum. And the growth has actually accelerated after the global crisis in 2008. Private credit offered by borrowers, they have better customization, better structures, and from an investor point of view, the perspective of higher yields and diversification benefits have lent credence to this avenue. So far, so good. So what is the next leg of growth looking like? One of the interesting things which I'm finding, and I think this view is shared by most of my peers across the industry, that Indian alternatives are focusing on attracting capital by learning from the global experience. There's a lot of learnings which is being taken in from a global perspective. India is going through structural changes. You have emerging opportunities like distressed assets, credit, and that is the reason why you have a lot of nuanced products coming in. Industry associations like IVCA are actually acting as catalysts to promote growth and regulatory interface. That's a very, very promising thing. There's a lot of collaboration to create a fertile environment for generation and growth of ideas. You have availability of service providers. In fact, organizations like PMS Bazaar are doing human service by providing the right type of information to their investors. Again, institutionalization will be a key driver. If you're talking about the Government Pension Investment Fund of Japan, that has been mandated to invest 5% of its incremental assets in alternate funds. So something like this will be a great fillip to the AIF industry in this country. If I have to take you to the PMS industry highlights, again, I go back to what the investor wants. In fact, 4 demands for the investor are actually being met here. Sources of alpha, diversification, capitalizing on emerging opportunities, but here this segment also wants to manage portfolio volatility. They're okay with concentrated portfolios, but they would like to see portfolio volatility be managed. Now, if you see why PMS is actually finding favor, the industry has stepped up. They've created curated portfolios. This is probably the only investment avenue where you can create a separately managed account for an investor or for a set of investors or customize a product according to his demands. It's an unbundled investment avenue. Every single expense is laid out to the investor. The investor knows where he's putting his money, what he's investing in, what the costs are. You can run with concentrated portfolios. Remember, this investor segment is very, very savvy. They understand the benefits and the risks of concentrated portfolios. So you could actually run a strategy here. More importantly, one of the reasons why I believe that this segment will grow by leaps and bounds is because there's a lot of emotional engagement by the investor. Think about it. Here is a demat account in which every stock being bought by the fund manager actually results in a message coming to your mobile saying that stock bought, stock sold. It's almost like you are doing it. There's a lot of emotional engagement. And I found that typically whenever stocks are bought and sold, investors want to know why. So there's a lot of emotional engagement which always augurs well for an investment avenue. If you have customer demands, if you have products, the growth of the industry is a natural corollary. The industry has been growing. The discretionary, non-discretionary advisory breakups are given here. The total AUM has grown by over 23% since 2012. That's virtually doubling every 3 years. And the potential is to actually grow by 6x by 2031. Well, PMS numbers here include the EPFO numbers, but I think the actual PMS numbers are close to 300,000 crores. This is just a snapshot. It is not a question of one investment avenue over the other. India as a market is growing very rapidly. Investors are becoming savvy very, very rapidly. They're understanding what is happening globally. So all investment avenues which offer certain nuances to certain risk profiles will grow. And you're actually seeing that. So far, the manifestation has been happening in the mutual fund, equity portfolios. This is an HNI segregation, 5 lakhs and above. It's not necessarily the right segregation, but it just gives an idea of what the industry growth has been. On one side, you have the mutual fund, equity, HNI portfolios, which have been growing at a CAGR of 25% odd. You have commitments raised by Cat 3 AIs, which have been growing by 50% odd, and PMS growth, which is at around 15% odd. If you just go to the right-hand side of the table, you're comparing debt with AIF Cat 2, and I must confess, AIF Cat 2 is not necessarily just debt data, it's an overall piece of things, but it will give you a fair idea of where things are moving. There are products available for all investors, and that is the reason why growth in the alternate space will be as good, if not better, than any other space. Again, in the PMS space, institutions like APME, the Association of Portfolio Managers of India, are doing a very, very good job by talking to the regulator and understanding what the investor needs are. Any industry, The moment an industry association comes in, you can rest assured that there'll be a lot of streamlining of processes and a huge amount of regulatory interface, which is ultimately going to benefit the industry. Moving on, if I can talk about Sundaram Alternates and our offerings. Sundaram Alternate Assets Limited, that's the company I represent, is a 100% subsidiary of Sundaram Mutual Fund, which again is a 100% subsidiary of Sundaram Finance. These are marquee names. These are names we've all grown up with. Excellent pedigree, long track record, and being extremely conservative and investor-friendly. Why I'm saying that is, at the end of the day, I believe that whenever an investor puts in money, comfort is more important than conviction. You can go and talk to an investor about 10,000 things, but at the end of the day, the comfort of a brand, the comfort of an advice is something which he will ultimately seek out. And that is where I think as an organization, we are uniquely placed to give the comfort of an institutional brand delivering a personalized, if not a boutique experience. We have portfolio management, alternate investment funds and advisory services, and of course, we have a plethora of products along there. Now, very quickly on our products. Across the AIF space, some of the funds which we offer, in the Cat 3 open-ended space, we have Sundaram Atlas Fund, which invests in equities across market caps and sectors. There's a close-ended fund also. Sundaram Atlas is an open-end fund. We also have a close-ended fund. It's Sundaram India Premier Fund and Sundaram Econ Fund, again tapping into different growth segments of the economy for the investor. Category 2, we are one of the first ones to have actually launched a real estate credit fund, and we've capitalized on the entire ecosystem and knowledge which our parent company Sundaram Finance and our group company Sundaram Home Finance bring to the table. In fact, Series 1, we've deployed over 570 crores, and I'm very happy to report that we've returned all the money. Over the last 6 years, you've seen what has happened to the economy. We returned all the money with a gross return of over 15%. One of the reasons being that we've invested selectively in Mumbai and Pune, but predominantly in South India. Currently, we have a Category 2 fund, a corporate debt fund. This was the space I was talking to you about, a private credit fund, which is investing in high-yielding debentures and mezzanine securities of MSME, SME, fintech, manufacturing and services companies. My initial expectation, what I'm seeing out there is a lot of family offices, apart from ultra HNIs and corporate treasuries, have started asking for this product. When we're talking about portfolio management services, we've been around for quite some time, okay? Although we have 5 key portfolio strategies with unique underlying themes, we don't believe in launching products just for the heck of it. There are 5 key portfolio strategies, which are very focused strategies. And if I can share with you, we just had a discussion on CAGR and how a long-term track record actually makes sense. Well, here is a long-term track record. Sundaram India Secular Opportunities portfolio over the last 12 years has given an alpha of 6.9%. For people who understand the concept of alpha and how difficult it is to generate, they will be deeply appreciative of this. This is all post-expenses. Sundaram Emerging Leadership Fund has generated an alpha of over 8.8%. It's actually 8.3% over 12 years. And Sundaram Voyager has generated an alpha of 7.2% over 11 years. My team will be very happy to take you through some of these products. They're standing outside. More importantly, this is a product which is widely available. It is recommended by all blue-blooded private banks, private wealth outfits, and IFAs. And chances are that if you go and ask, your neighborhood relationship manager or investment advisor will talk to you about it. To paraphrase a statement, with great performance comes great recognition. Very privileged to have received 3 awards from the PMS Bazaar Forum last year. 3 of our products, Sundaram India Secular Opportunities Fund, PACE and SELF, the Emerging Leadership Fund, have actually received awards, and I'm actually hoping that the trend continues today evening as well. Talking about our ratings for our close-ended AIFs, both our close-ended debt AIFs have been rated CARE AIF 1, which talks about the fund's asset selection ability and risk management capabilities in their respective segments to be excellent. The research capabilities, talking about the research capabilities, just a few points I'd like to highlight. We have a strong research team with over 2 decades of experience in identifying tomorrow's winners. Incidentally, we were pioneers of the mid-cap and small-cap strategy 20 years ago when the whole world was focusing on large caps. There are over 300 corporates which we actively cover. In terms of debt, like I mentioned to you, we leverage on Sundaram Home Finance presence in the South Indian real estate space. And we have access to high quality deals from borrowers because of the entire ecosystem of Sundaram Finance and Sundaram Home Finance. This has been the growth of the organization over the last few years. We have 4,500 crores of assets under management currently across all products which we offer. Almost 50-50 is PMS and AIF at this point of time. And we are hoping to grow much faster going ahead. State-of-the-art customer support. There's digital onboarding, online access, access to Sundaram customer service staff across the country. We are present in 76 branches across the country. And apart from everything else which is available online, we also provide audited certificates to enable filing of annual tax. That's been my time, ladies and gentlemen, and I hope that I've been able to give you an insight in terms of how the industry has been growing. I talked to you about the growth of the industry, juxtaposed with what investors are asking. I also talked to you about how the industry is growing, not too differently from what the global trends are, but having a personality of our own. I'd like to thank PMS Bazaar for this opportunity. And I'd also like to thank Team Sundaram Alternates and Team Substack for helping me create this amazing deck. Thank you very much and have a great day ahead.